Now, perfect. Okay, so let's look at our company, Gentex Corporation. The interesting thing about it that their major product is Gentex hybrid full display mirrors, and they kind of adjust the tinted mirrors when your car drives behind you. It changes straight away the way it reflects that you're not blinded. Okay, and it's quite popular. It's one of the biggest companies in the world in this particular sector. Okay, but what interesting I found that it deals in three sectors. So first is auto dimming mirrors, as I said, so it dims when you see the car approaches. But also it's builds aircraft window systems. It's quite new systems, but I already flew a couple times in systems where I didn't see any blinds, and it was dimmed sometimes by pilot. Sometimes you can use it yourself and dimmed it by the control. Okay, and then they have completely out kind of different type of product, commercial fire protection. I even don't know how they come up with this product. Must be a first class thing. Not necessarily. If they change it's in the plane, they change it everywhere. It's actually very convenient for the pilots and stewardess because they don't have to go and tell everyone, okay, lift it up or close it down or whatever. So they can do it from the pilot room. But that's what was quite fascinating. So it's very, very different product. Nothing relating to these two products. If here I can understand somehow that they start doing it, but I don't really understand how they come up with a fire protection product and why they diversify in completely new industry. But still, these two parts, these two aircraft window system and commercial fire protection, not still not big part of their whole business, right? But it is growing, and for me, it's quite interesting to see that if something bad happens, let's say that company, like economically, I mean, this company will be affected. Okay, we discussed it already because mirrors you probably don't change, at least in internal mirrors. External mirrors, something break them and you need to replace them. Okay, whereas aircraft also people probably won't buy new aircraft during economical downturn, but fire protection has to be. It's in any way. So you have to replace it, you have to put it, and etc. 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 So it has to be that particular business. Now, a good thing which I liked that 67% of their revenue comes from outside of US. So if one country is affected, so we know that they have quite good business in Asia, they have quite good business in Europe, not only US. Okay, and it means that if one area will be affected by economy, other area could be otherwise like performing much better. The bad thing, which I think is 10% of their revenue, is created by 3 clients. I don't know, guys, if Dory, you said you analyzed their website. Do you know who are 3 clients there? If not, I won't tell you. You recommend, you look at yourself, okay? So you know, and when you know the clients, sometimes it's pretty good because the operation cost to deal with one client it's much less than dealing with hundreds of clients. But at the same time, if that client for whatever reason decides to move to another supplier, you can lose quite a big chunk of your own business. Okay, that's about product, guys. I told you about product. What kind of risks you can see here based on the product, especially those guys who drive new cars? Can be their product affected by other industries? What do you think? Can be their product replaced? I'd say like that. Yeah, competitors, yes, definitely. But they're good quality mirrors, and because they are size, they're competing with those companies already. But do you see something coming what can replace windows at all, or like mirrors? A lot of new cars now they have what instead of mirrors? They have cameras. Yeah, and also all these driverless cars, they don't have to have mirrors either because there is no driver. Probably because it's still half and half. They will have it, but if there are cameras there, you probably don't need to have a rear view mirror. So that's kind of the, would say, a weakness of that particular company. So if they don't adjust quickly, so their profit might be affected. That's probably reason why the company like dropped in price nearly more than 20% within last 6 months, because people start talking about it, and I read quite a few articles which are discussing this type of issue. But I believe it will take years until that particular kind of technology will replace mirrors. Presume cheaper cars, they still will be using rear view mirrors. Okay, it won't happen. But then we don't know how Gentex is going to behave themselves. Are they going to like start building and manufacturing cameras, or maybe they will create a partnership with companies like Sony, Panasonic, which have no at the moment ideas how to deal with the automotive market, but they're moving into that, and probably they're going to look for different partners in that particular industry, and maybe Gentex would be one of them. Okay, and also we see that they're developing 2 new products. Oh, great! Volkswagen Group, Toyota, and Ford. That's correct. Yeah, that's good. So you notice, yeah, so they have European, Volkswagen, Toyota, Japanese, and Ford, it's American company. So 3 clients in different countries, so which is good from one sense. Yeah, they in general all good with that company. I really like that company. Actually, we analyzed this company about 2 years ago. It was dropped at that stage. We bought it, it moved up, we sold it, and now it's down again. So I noticed it about a week or so ago when it's dropped down. So and start analyzing, it's actually moved already up quite a lot. So I hope that it will move down again, that you will have an opportunity to buy it. Now, when you look at the industry analysis, you will see that value line gives us kind of good outcome, and it tells us that it has rank 6. So 6 is one of the best ranks. Remember that up to 25 we consider the best industry ranks, and then already the higher the rank, the less company like industry has a potential to grow within the next 12 months. So we can see that value line tells us that it has the highest potential to grow as an industry as a whole. But then when you look also, the another rank is timeliness, and there is one company here, actually 2, Dana and Lear Corporation. Now I looked at both companies, and to be honest, I didn't really like Dana because their sales level going down and down and down for the last few years. But when I looked at Lear Corporation, I really liked it. So I even was considering to analyze Lear instead of GNTX, but then I decided to give it to you to analyze this company. So please do it, okay? I will put reports for you in Facebook so that you can do it. But then what we can see here, GNTX. GNTX, if you compare, that's the size of companies. You can see that there are much bigger players on the market than GNTX, but they don't produce the same type of product. If you look at GNTX, it's the biggest in their particular product, so they're developing the highest volume of rear view mirrors. Okay, they're leaders in that particular industry. Okay, Lear, which another company which I kind of recommended to have a look, they deal with the seats for the car. Okay, so it's nothing to do with mirrors. So they are not really competitors between each other. All right. So that's about industry in general. Okay, let's have a look now at value line report. So the price when value line report was in June, I think it was in June. So 1880. At the moment, the price $1 lower. It's $17. I think it's 67 or 69 cents right now. P ratio at that time was 14. Now, if you deduct $1, the P ratio now is something like 13.7 times. So it's lower. Okay. Now they pay dividends, about 2% on that price. Now value line sees the company between $25 to $40 in that price range in 3 to 5 years. Okay, so which represents from 9 to 22% growth on a yearly basis. Now, if we look at sales, okay, first line, I'm going to look at from 2001, but then in technical analysis, I'm going to show you the move of the company from nearly 1984, so it's nearly 30 years ago, okay, and you will see if you invested in that company at that stage, how much money you would make. Okay, it's quite interesting when I find companies like that. So look, sales $1, $1.30, $1.50, $1.60, $1.70, $2, $2.20, $2.27. We can see that it slowed down their growth here in 2008, and then $1.97. So it dropped 30 cents. So it's 15% of drop in 2009 when all market was collapsing. Now, guys, do you think it's 15%? Is it a big number or small number? You analyze quite a lot of companies already, and you probably have seen that some companies like halved in their sales levels, right? The fact that companies sold only 15%, it's not that bad, okay? And especially taking into consideration that, look, in 2009, 2010, it's moved quite fast up. It's moved $1 up. So it's actually sold, like the growth continued. It's like if you take this probably year away, it would be same type of growth, same level of growth on the sales level. And then it's continued 3.5, 3.8, $4, $4.60, $5.30, $5.84. And this year they're planning to close $6.40. And then they're planning to go $6.90 and $7.90. So what do you see here? Do you like the growth? What happens with sales? Consistent growth, right? Non-stop. Only 1 year of dropping is when all world was ending, like in 2008. So it's pretty good, right? So like the company. Then we look at earnings, because sales are sales. We interested in earnings, how much money we put in the pocket. Okay, look, same, third line, 22, 28, 34, 36. Here the drop, 35, then 37, 43, and that's where drop was nearly half. So they halved their earnings. They had 43, become 22, right? But they were still profitable. That's a good thing about it. Their sales level dropped 15%, but their earnings halved. Okay, lost 50% in their earnings. But look at this, then it's doubled, 24 to 49. So quickly recovered and then went back to the norm. And again, it's 49, 57, 60, 78, 98, $1.08, 119 last year, planning to close 130 and then to go to 175 during that year. So what can we say about earnings? Similar to sales, right? Stable. Only 2 years within last 18 years they had slight drop. Okay, one drop is here. We don't know what was the reason here, where it was 36 to 35 cents, right? And but here was a drop which is quickly recovered, and after that, cash flow is always good. Okay, we can see that cash flow is always higher than their earnings, so they get more money every year than their earnings. They kind of reduce the tax. Look, they pay dividends, quite good dividends, and constantly increase. In the thing, remember that this year, last year, they paid 36 dividends. Now, I'll tell you already that in 1984, if you invest in that company, you would pay 8 cents for the share. So if you imagine that you put 8 cents and now you get 36 cents, so it's what, 4.5 times, 4 times, right, higher. So it's, imagine like you invest $1,000 now you would get $4,000 in dividends, which is pretty amazing, right? Okay, another thing which probably worth looking is PE ratio. PE ratio always was 30, 26, 21, 22. Look at this, 17, 15 here in 2013. And last year and now it's 13.5. So can you see it that most of the time investors were paying sometimes 33 times higher than earnings of that company, 30 times higher, 15 times higher, and now it's only 13.5. So it tells us that right now, investors, for whatever reasons, yeah, they are paying less based on their earnings. So and it's quite good. So it tells us that at the moment it's priced lower than it has ever been before. Okay, which is good if you're value investors. But again, we have to understand that not to get into value trap. So if the company would be replaced by other type of products, cameras, right? So it might continue to slide down. So and the product will be not needed for the company. So again, if you look here, you will see all these sales are growing fast. Operation margins quite healthy, 35% in general. And if you look at net profit margin, you can see it's around 20%. And I always look at that areas, and we can see remember that 15% drop in sales resulted 50% drop in earnings. Why it happened? That's why, because look, it was 18% margin before and it's become 10. So they adjusted it. And in order to be competitive in the market, they reduced their margin, but they were still profitable because they have good level of margin. That's why Warren Buffett prefers invest in companies with a good margin safety, because if something happens on the market, they still can reduce the margin and compete with other competitors. If the company has only 5% here, imagine, so it's much more difficult to reduce your margin and to be negative. Okay, that's the thing. And all the rest is pretty good. So we can see that share equity, so of shareholders constantly growing, which is good for us. Total return on capital also good. So that's kind of the company. Okay, so let's have a look at capital structure and debt. So at the moment they have 36 million in debt, and capitalization is 5.4 billion. So I presume you kind of get it's quite low, especially if you look at net profit. And last year the net profit was 347 million. So it means that they can pay this debt within what? Nearly like 1.5 months of their profitability. So it's pretty easily. So no problems with that at all. Another thing, if you look at long-term debt, actually historically they had no debt, and only in 2013 they borrowed $265 million, which were reduced gradually until last year. Last quarter, I think even, they paid all the debt. Yeah, so they paid practically everything. And you see, we can see that they're going to reduce it even lower. So this company is quite stable, and something happens in the market, they quite easily can handle it. And let's have a look at how much cash they have. Okay, cash assets. Interesting enough that, look, they even paid 170 million of debt last year. What we can see, their cash equivalent, did it change a lot or not? Here 550 million, 546 million, 559 million. So it's actually grew. So they have more cash than even before they had. So they're quite stable in that particular way. And if you look at current assets, right now they have nearly 2 billion in assets, current assets, and only 270 million in liabilities. So it means that they have about 900 million of their like positive balance. Okay, it's pretty good one, and most of it's in cash. Okay, 559 million in cash. So it is very, very good. Now the thing is that here inventory, I can see that it's slightly growing, 174 million, 189, 197. So it's each year it increases about 10 million. Now you have to pay attention to inventory, especially if you see that sales are not growing, but inventory are growing. In our case, we can see that sales are growing too, and inventory growing with them. But also, the company GNTX manufactures the product which is not as bad affected by like high level of inventories like vitamins or pharmaceutical product or clothing. Why? Because if you produce some vitamins or some drugs, they have expiration date, and if they manufacture too much of it, they have to destroy it, right? So it's expired. Similar situation happened with New Skin several years ago when we analyzed that company, and after that they had to destroy a lot of products which was prepared for China, and China took the license away from New Skin. As a result, after they lost the license, they had to write off quite a lot of inventories because they couldn't sell it. Okay, in this particular case, we know if they manufacture the mirrors, expiration date, they don't have any fashion like preferences. So if they don't sell it this month, they might sell it in 6 months' time. Okay, so that's the advantage of their particular product, and designs, they stay in the car for quite a while. Okay, that's the plus. Now, if we look at the annual rates, growth rates, what we can see here, that 10 years and 5 years, within the last 5 years, the growth was faster. I presume it happens because here they take into consideration the drop in 2008. Okay, but still the growth is pretty good. Sales 11% and 13% in the last 5 years, and earnings 11 and 20% in the last 5 years. So it's pretty impressive, right? And we can see dividends are growing, book value is growing as well. But here we can see that value line predicts that their growth would be less. Again, value line puts these numbers here based on their conversations with management and company projections. So 7 and 8.5, it's lower than here. To be honest, I didn't look at this, but if you want, you can go back and download from value line some reports which dated 2 years ago and see what growth rate they predicted at that time. Because sometimes companies, they try to say lower numbers and then overperform it rather than overpromise and then underdeliver. Okay, so it kind of looks much better in majority of cases. Remember, we analyzed Syntel a couple of months ago, and we were talking that that was an Indian company, and it was like their earnings predictability rate was quite low, and it looks like they always were wrong in kind of in a good way, because they would tell you we make $1 and they will make $1.05, and then they again will make $1.20 and they will make $1.25. They always under promise, and their earnings predictability rate was bad, but they constantly made better results than their kind of promises. Real results better than their promises. So who knows, maybe GNTX, it's similar type of company. We need to have a look at this, okay? But definitely I see that earnings predictability are quite good. So they are right 9 out of 10 times. So I probably say it is yes. Now, if we look at quarterly sales and quarterly earnings, pretty stable. There is no huge volatility here. Okay, if you notice it, some companies, they have seasonality, and one quarter is very high, second quarter is very low. Here is pretty stable. Okay, and we can see the dividends constantly growing. Another thing which I would pay attention to is actually, despite very even earnings, look at the price fluctuation here. That's what's really interesting about this company. Look, they always move quite a lot. So here, $8 and $15. It's like 100% move up, 10 to 17, 70% move, 7 to 15, 100% move, 9 to 17, about 90% move, 13 to 90, again 60%. So you can see that every year company goes up and goes down quite a lot. And that's why probably beta here was beta 125. So it's much higher than the market. So it moves up a lot and then it moves down a lot. So definitely this company is not for kind of weak-hearted, yeah. So the people who cannot handle emotions, because believe me, if you put here $19,000 and it becomes 13 within the same year, it doesn't feel right. Of course, it can go other way around. So if you bought at 13 and it becomes 18, you're quite fascinated and happy, right? So that's why it's very, very important to buy this particular company on a low. Okay, if we buy it, the move up can happen quite quickly, and that's all happens despite this smooth operation. Okay, that's good. Now, company financial strength B2. I don't know why they put B2. For me, it looks like pretty strong company. No debt, all good. Stock price stability 45. We understand why. Price growth persistent 70 and earnings predictability 90. And also what I noticed that directors, they have 2.5%, so all directors, but one director, chairman and CEO, Fred Bauer, has 2.3% of the stock. So which is pretty good, right? So it's pretty big number for one person to have. Okay, guys, that's fundamentals of the company. You looked at this, you already, some of you analyzed it. So what would you tell me? Is it a good company? Without putting numbers in the table, what can you tell? Do you like this company fundamentally from as a quality company? Yeah, definitely. Definitely. Pretty good, impressive company. It's one of the stable companies, yeah, from quality perspective. From price point of view, what do you think? From price point, do you think it's based on what the price we see now and P ratio, etc.? Do you think it's undervalued, overvalued, or average? What do you think? Without putting numbers in the table. Whoever knows. Yeah. Okay. All right. Okay. Good. So let's put its numbers. So quality, it gets 41 point. Now where it loses points. First of all, timeliness, because value line sees that company is average growth. Industry is the best. Safety, again, for whatever reason, value line puts average here, so it doesn't give the maximum score. And also beta is quite volatile. So all of them, especially beta, it might be bad, but also it might be good, right? Because for us, when the company is volatile and if we bought it in the right time, that's the best thing which can happen, because after that it's really quickly goes up, right? So, and if it's not volatile company, it might be moving quite low. Remember, we analyzed Hershey, right? Very good company, but not that volatile. And look at this, it moves up, but like about 10% in total, and like within 6 or 7 months, whereas Gentex can move like 100% within 1 year. Okay, so which, but the rest of the most important growth trend is fantastic here. Management is good, and the rest of its debt is close to zero. So that's why TAC guide is 4 here. So it's maximum. So it's about 40. Now, if we look at price analysis, so that's what we can see. Again, look at these gaps between prices, low price a year and the highest, 7 to 15, 9 to 17, like from 50 to 100% nearly a move every year. So definitely it's not for, like, I mean, for people who cannot handle emotions, because, or especially who just starting investing, because if you enter a position in the wrong time, even if in the long term it's going to be good, but in the short term it might go like 15 to 20% down, okay, which you have to be able to handle emotionally. Now, if we take average profitability within last 5 years, and then we calculate average lows and average highs, so we come up to 2 numbers. First, P ratio 12 and P ratio 19.6, like So it means that sometimes during these 5 years, in average, when everything was emotionally bad about this particular company, people were paying 12 times of their earnings in average. And when everything was rosy and nice and good looking about the future of that company, people were ready to pay 19 times of their earnings. Now, knowing this number, we can predict that, okay, if it wasn't happening in the past, it might be happening in the future again. So, and because company promises us that they're going to make $1.75 in the future, and just show you where this number came from, we can see it here, right? So if they are promising us to make $1.75 in the future, and we can expect that sometimes it can be 19 times of their earnings, so the price might go to $34. Now, in the worst case scenario, we can see, okay, what happens if they're going to pay only 12 times of their earnings? And if earnings are not going to grow or stays in the same level as last year, $1.90, that's what they made last year. So the price will be about $14. So it's below the price. So that's how we know the lowest price, we know the highest price, then we just break it to 3 areas, and we come up with another 2 numbers. So where we buy the company between 14 and 21, where we hold the company between 21 and 27, and then where we sell the company between 27 and 34. So that's kind of estimates. We know that about 30% of the time it would be in this range, 30% of the time in that range, and 30% of the time in that range. Okay, so and if we're buying, we're going to buy definitely below 21. Where is the price now? Okay, when I analyzed it was 16.90. Now it's 17, I think 69 last night. So it's moved what, nearly 70 cents, 80 cents. Right? So you could make, if you found it at the same time as I did, you would make what, 5% already on the move. So, but why it is important to know, even if you put here 17.70, which price is right now, you still will come up to pretty good results, because look, we have a potential to grow from that number to 34, right? And we have a risk of going down to 14. So our risk is $2.46, and our potential is $17. So if you divide 17 by 2.4, it's 7. So 7 times higher growth rather than loss in potential. So definitely we're trying to find anything above 3. So this company definitely good. It's not as good as the last 2 companies which we analyzed, which were below that price. Okay, we found few companies which were below that price, but still pretty good. So that's why, based on KCM guide, we can get 52 points here. Okay, tangible book value 4.7, and earnings would be 19th of October. So we have plenty of time to do something with that company without any kind of surprises, earnings surprises which can happen. Okay, that's what we can see. So definitely company is undervalued based on fundamentals. But remember, fundamentals are fundamentals, but millions and millions of people, hundreds of millions of people, they place their trade based on what? First, news, emotions, and technical analysis. Okay, so that's why you need still to read news, what is happening there, because if you understand how it works, you might pick up the company cheaper. It will be good now if you buy it at that point, but if you buy it cheaper, it would be even better, right? And also based on technical analysis. And now we are going to go and see technical analysis. But before we go there, I want to, like, if you have any questions on the fundamental part, if everything is clear, pluses. Okay, great.